Welcome to Indiquity. We publish videos that share information and knowledge to make the common Indian investor well-versed with the ways in which Indian equity markets are structured and function. We're starting an exciting video series that explains Indian industry structure, the way Indian companies are classified in different sectors, industries, and basic industries. The aim of this series is to understand this structure correctly so as to search and compare companies to be able to take informed investment decisions. Let's begin.
We have already seen how the Indian industry is structured and how we are going to study it in our earlier videos. If you have not seen them yet, we urge you to watch those videos so that you can derive maximum benefit out of this and our subsequent videos. Links for our previous videos are given in the description below. We are starting with the commodities macro sector. As you all have already seen in our previous video, this macro sector has four sectors within it: chemicals, construction materials, metals and mining, and forest materials. Let's deep dive into the chemicals sector, which has two industries underneath it, namely chemicals and petrochemicals, and fertilizers and agrochemicals. From the chemicals and petrochemicals industry, we have chosen the first basic industry, that is, commodity chemicals. Let's have a close look at this basic industry, which is at an inflection point due to several factors.
The commodity chemicals basic industry in India, as defined under the National Stock Exchange classification framework, focuses strictly on high-volume, price-driven chemical building blocks such as alkalis, bulk organic intermediates, and inorganic chemicals. These products are largely undifferentiated, closely linked to energy and feedstock costs, and form the foundational inputs for downstream industries ranging from textiles and paper to construction, consumer goods, and infrastructure. Importantly, this analysis excludes specialty and performance chemicals, which operate under fundamentally different economics driven by formulation, customization, and intellectual property rather than scale. From an economic standpoint, commodity chemicals have moved from being a background enabler to a core industrial pillar. As of 2024, the Indian chemicals industry is estimated to be valued at approximately $250 billion, with commodity chemicals accounting for a substantial share of this base and contributing close to 7% of India's gross domestic product. This level of contribution places the industry among the more capital-intensive segments of Indian manufacturing, indicating that it is not only large in scale but also deeply embedded in the country's industrial and infrastructure cycles. The implication is clear. Any sustained expansion in housing, urban infrastructure, or manufacturing output directly transmits into higher chemical demand.
The macroeconomic and policy environment surrounding this basic industry is unusually supportive by historical standards. In the Union Budget for 2025-26, allocations to the Ministry of Chemicals and Fertilizers stood at approximately 1.62 lakh crore rupees, signaling a long-term fiscal commitment rather than short-term stimulus. Complementing this is the broader production-linked incentive framework, including schemes such as the Advanced Chemistry Cell Battery Program, with an outlay of about 18,100 crore rupees. While not all such schemes are directly targeted at commodity chemicals, they materially raise downstream demand for bulk chemical inputs. The policy direction is therefore not merely about capacity addition, but about correcting India's historical dependence on imports by strengthening domestic manufacturing depth.
Structurally, the commodity chemicals value chain in India remains heavily concentrated in a small number of high-volume products. Alkali chemicals account for roughly 71% of total commodity chemical output, followed by organic chemicals at around 15% and inorganic chemicals at close to 9% in the 2023-24 period. This skewed distribution highlights two important realities. First, India has built a strong base in scale-driven chemical manufacturing, particularly in products where cost competitiveness and logistics matter more than differentiation. Second, it also exposes a structural limitation. Value addition remains low, margins are cyclical, and profitability is highly sensitive to energy prices and capacity utilization. In practical terms, this means the industry's earnings profile tends to oscillate sharply across cycles rather than compound steadily.
Demand-side dynamics reveal why this basic industry is now at an inflection point. India's per capita chemical consumption stands at roughly $91, compared with levels exceeding $1,200 in developed and large manufacturing economies. This gap is not merely statistical. It reflects underpenetration across housing materials, sanitation, packaging, industrial manufacturing, and consumer goods. At the same time, domestic capacity has not kept pace with demand in several key commodities. For instance, PVC imports crossed approximately 26 lakh metric tons in FY24, meeting nearly two-thirds of domestic consumption. These numbers indicate that demand growth is no longer theoretical. It is already forcing imports, exposing domestic producers to competitive pressure but also highlighting the scale of the opportunity for import substitution.
Looking ahead, the growth trajectory implied by current data is unusually steep for a basic industry. The Indian chemical sector is projected to reach around $300 billion by 2025, with long-term estimates pointing toward a $1 trillion industry by 2040. Achieving this would require India to increase its share of the global chemical value chain from about 3.5% currently to roughly 6% by 2030. This target is ambitious but not implausible, provided large-scale infrastructure such as petroleum, chemicals and petrochemical investment regions, PCPIRs, progress as planned. The interpretation here is that growth visibility exists, but it is conditional on execution, logistics efficiency, and sustained policy continuity.
Despite this positive outlook, the commodity chemicals industry carries structural risks that cannot be ignored. The most significant is feedstock vulnerability. India's crude oil import dependence stood at approximately 86%, exposing chemical producers to global energy price volatility and geopolitical disruptions. This is compounded by a persistent chemicals trade deficit of around $31 billion, reflecting continued reliance on imported intermediates and derivatives. Together, these factors mean that during periods of global oversupply or energy price spikes, domestic producers can experience sharp margin compression despite healthy end demand. In other words, scale alone does not guarantee resilience in this industry.
From a neutral, sector-level investor perspective, commodity chemicals in India appear to be in the expansion phase of a cyclical value creation loop. Balance sheet indicators suggest moderate leverage, with sector-wide gearing estimated around 0.5 times, implying that the industry retains financial capacity to fund capacity additions. However, returns will remain highly sensitive to timing, capacity discipline, and cost control rather than innovation or pricing power. This makes the sector structurally different from higher-value chemical segments and reinforces the importance of cycle awareness.
In closing, the Indian commodity chemicals basic industry is undergoing a transition from a domestically oriented supply base to a more globally integrated manufacturing platform. Its ability to potentially generate 700,000 to 1 million additional jobs by 2030 underscores its importance not just economically but socially. Yet, its long-term success will depend less on headline demand growth and more on resolving structural constraints around feedstock security, logistics, and capacity planning. For investors and learners alike, the key variables to track will be import substitution progress, energy cost dynamics, and the pace at which infrastructural clusters become operational. In that sense, commodity chemicals remain a sector of scale, discipline, and timing rather than differentiation.
Stay tuned to see our next video where we will analyze yet another basic industry from Indian industry. And if you are liking our videos, click on that bell icon below, like, subscribe, and share. Your support motivates us to bring better content every time. Thank you for watching.